Ventures and kind of what you're looking for, what you're interested in.
So Access Venture Partners is a 16-year-old early-stage venture capital fund headquartered here in Colorado. We do most of our investments in Colorado and the Rocky Mountain region. We typically invest in the Series A, the first institutional round. Sometimes we'll go earlier, sometimes we'll go later as far as the first investment. And we mostly invest in tech companies, IT related, but sometimes we'll stray into other areas, like we're investors in Inspirato, which is a big travel company you may have heard of here in town. We like to get to know entrepreneurs early, so even if you're earlier than a Series A, we're always happy to get to know you and track you and follow you, so that hopefully you get to a point where we can back you.
Hi, this is Venkat Devraj, and first of all, I just want to commend the organizers on a phenomenal job today, Richard and the Software Club and the Rockies Venture Club. Great job, guys. Great group here. Real quick, I'm Venkat Devraj. I'm one of the managing directors of Home Capital. And I also am CEO of one of our portfolio companies called Selecta. As a fund, we are about 3 years old. And really, we started it as a way to kind of come in right between angels or friends and family and VCs. And we found that there was a gap there for a lot of people that are pre-revenue, that really have a great idea, that have an it factor. The founding team is impeccable in terms of credentials. And fundamentally, we invest in companies like that. So to give you some examples, like a great team. We also have little more technologies. We also invest in non-IT. So we have investments, about a total of 9 investments total over the last 3 years. We also have invested in thermal mining. And so really, the team matters a lot. It doesn't have to be a repeat entrepreneurs. It all comes down to do they believe in it, how well they execute, and do they have the passion and really the grit to make it happen. So that's in a nutshell.
I'm Roshko with Boulder Ventures. Boulder Ventures has been my partner Kyle across prior experience. Colorado Venture Management has been in the Colorado market as venture capitalist for about 30 years. I started my career in 1984 at Sandhill Road and moved here about 11 years ago. We are sort of classic early stage Series A round investors who are not fund-based. As Venkat was saying, we tend to try and follow a group of entrepreneurs around that we have funded in the past and we built relationships with over the years. But we will invest really in anything IT related. Kyle and I focus almost exclusively here in Colorado. We have an office in Washington, D.C. Our partner Jonathan Boulder invests in the United States, so we do restrict ourselves tightly geographically, and that has worked well over the years.
Great, thanks. Alan talked about some important KPIs for software companies. What KPIs do you look for, and how might those change over the life of the company?
Well, if you're talking about a software as a service company, which is what most of the presentation was about, you touched on a lot of the very important ones. Understanding your CAC to LTV, your customer acquisition cost ratio, their total lifetime value of your customers is critically important. And early in a business, understanding the payback time on that CAC. How long does it take you to get paid back and what it costs you to acquire the customer is a really important metric and measure of the ability to have accelerated growth with more capital. There are other metrics that are important too, but I would say to summarize for a SaaS business, those are some of the most important.
For us, because we invest in diverse areas, the software, the SaaS metrics that David talked about, a lot of them tend to be table stakes items, fundamentally. And what we fundamentally hone in on is, what are the value elements that the venture is bringing to the table? What is it bringing to the market? Whether it be end customers, whether it be partners, and how do you quantify that value element and how do you monetize it? And some of our investments are pre-revenue, so we look at the potential and we look at essentially not about fundamentally, even though this is an M&A conference, we believe that people who are looking for an exit rarely find it. So exit, like most things in life, happens. And it has to be ancillary, it has to be incidental, it has to be a focus, a relentless focus on the value element and the monetization roadmap.
I don't know that I have anything to add. It's unit economics, it's size of market, and it's what's your position.
So Peter, I know you guys have done a little bit in different areas, including life sciences and some hardware. What other metrics, if you were to look at a sort of a SaaS or maybe a software, sort of hardware combination type company, but are there any other metrics that you would look at?
No, I mean, I think these guys and the parts that you covered the basic business growth metrics that make an attractive economic model, but ultimately you get paid on strategic value. So those things may not be captured in those operating metrics, but maybe something as simple as average deal size. Right? Average deal size is going up. That generally indicates increased strategic value to the large consolidators. So it's going to depend from market to market, as Venkat pointed out. Some of the things we've done, for instance, line rate systems, this very intense kernel level software for the software-defined networking market. It was all about the metrics around the software itself and how quickly it processed bits. Turned into a very valuable company with almost no revenue. So it's going to depend a lot on the marketplace. So for SaaS software,
Public markets have not been kind to tech IPOs recently. How do you see that impacting valuations on the seed and Series A?
Well, I think everything sort of keys off the public markets when we can. But the other factors that are driving valuations right now, I think primarily has been just way too much money in the business. And we asked about Series A valuations, and I guess they've been coming down, but I think the interesting thing in this cycle is that this is really the first time that in my career I've seen actual seed valuations be affected by the indigestion going on in the public markets. It used to be that seed valuations would change cycle to cycle, but there's been so much inflation in those valuations in this current cycle that they're actually coming down by 50, 60, 80%. It's interesting to see how that plays out. As Series A investors, we've historically felt somewhat insulated from the valuation gyrations going on in the later stages. It just didn't affect that much of what we did. We were investing $2 to $4 million in a round, 40 to 60%. That was this time things have gotten inflated so much in some sectors that it's actually affecting the early stages.
We fundamentally don't even bother looking at that thing. And a lot of the reason for that is, IPOs these days, right, they're like a bluebird. You just, for a bluebird opportunity or a black swan, whatever terminology you want to use, they just are not happening. And so when we come in, an IPO is such a long shot, it's not relevant for us. So we look at, is the business going to be around 5 years from now, assuming there's nobody that's going to show up at VC on a white horse or shining armor, it's going to show up rescue the day. So are the business fundamentals strong enough, are the value metrics strong enough, and everything else we adapt.
So I guess from my perspective, first of all, valuations, at least in Colorado, have never gotten as crazy as they were in Silicon Valley in the early stages. So just like our real estate market here, they go up as high, so I don't think they're going to come down as much on a percentage basis as what's happening in the valley. On the one hand, it's really completely irrational that there should be a link between what's going on in the stock market and early stage valuations, because we're investing for an exit that is going to be years down the line. Who knows what the market conditions are going to be then? Nobody knows. But the reason that it does happen is it just all waterfalls down. The Series D investors see that the market IPO valuations are down, so they offer less money. The Series C investors see the D investors are tightening up in valuations, so they tighten up, and it flows all the way down. So that's why you do see that impact trickle down to some degree to Series A. But from a rational perspective, it should be.
You guys have been doing this for a long time, but it seems like recently there's been a lot of overhang on valuation. You touched a little bit on that. And companies are facing flat or down rounds. How do you guys view that, and what sort of advice do you give your CEOs in terms of trying to preserve capital or do something else to make sure that everyone's there?
Well, first of all, I guess, again, I would say this locally, we don't feel like we're seeing nearly the impact of what you're describing as what we're hearing from people in the Valley. So we just had 2 follow-on rounds of nice increases in valuation in our portfolio. And that's because, and it's part of what Boulder Venture shares us with access, we're in markets for a reason. We're in these markets, and one of the reasons is they're underserved. And so they don't have that same dynamic that you see in Boston and Silicon Valley, where there's just way too much money chasing the deals, and so you get ridiculous valuations at the early stage. But when we see that, we work very carefully with them to watch the burn and understand how much value creation they need to achieve in order to have a chance to go out and raise that next round, hopefully at an increase in valuation, and try and work with them on strategy to achieve that goal. Maybe it's going to take a little bit longer to get there, but you do with a lower burn model so that you can weather the storm.
One word, or maybe 2, bootstrapping. So a lot of the times when you look at an evolution of a company, we see it as essentially there are 3 main phases. And at every phase, you almost need capital. And so number 1, when you have the minimally viable product, the MVP, you have to have some kind of a seed round. You have to have friends and family around it. There is something happening there. Number 2, as you start figuring out product market fit, that is the biggest that most companies face. Either they die before that happens, or they die as it happens, and they're not really able to get there. You would argue that, and the 3rd phase, of course, is scaling. Essentially, once you have figured out the product market fit, getting the company to the next level. Our biggest advice is, don't worry about the down round, don't worry about the same price round. Fundamentally, do what it takes to figure out the product market fit. Because once you have figured it out and you're still around, there is going to be capital, there's money all over, whether it's bridge loans or whether it's Series A, whether you call it seed, but whatever you call it, there's going to be money around if you're able to demonstrate the right product market fit. So our advice to CEOs is focus on that element. Get the MVP out, get the product market fit figured out, and then magic happens. And money is going to be there, and we're there to support it. So,
what do? We try to reduce burn rates where we can, but we can't always. Not everything can be run profitably. It's a certain minimum burn in order to get to the next proof point. We certainly expect more internal rounds where we're not getting new investors to the table. And sometimes you have to look out 12 to 18 months and make a decision about whether this is a place where you need to sell the company, because it's not going to be feasible to release the money. Even if it's a good business, it might not be feasible to get to the next place just based on capital.
That's actually a great another follow-on question there. Do you think that the strategic acquirers are sort of looking at the current environment and taking advantage of what's going on? And are they really looking at the product and long-term potential when they're setting evaluations?
I mean, ultimately, you get a market price if you have 2 or more buyers at the table. If you don't have 2 or more buyers at the table, you're going to probably not get a good value. But I think once you get multiple people that are looking at your company, you're going to get a good market price. I think that they are influenced at a macro level based on the number of options that they have in terms of what they can buy. If you look at the big bubble in 2000, it took 7 or 8 years for excess sort of inventory of products in every category to wear off. And you really get good M&A multiples until you basically got to the next recession. Right? So I think that's probably going to happen here too. With all the capital that's really into the startup world, we're going to go through a period where any one of the consolidators has multiple options on what they can buy. So that's what I think impresses the prices.
A lot of the times, from a valuation perspective, one key driver that a lot of people miss is you fundamentally don't wait for figuring out which partner might be the right partner and go to the partner at a later stage, once you are ready, once you feel like you're thinking about selling. One of the pre-steps that has to happen, in our limited opinion, is you have to find which company can help you scale. It has to be about, once a product market fit is figured out, it's got to be about scaling the business. And there are a few partners. So a CEO almost has to think about this as, if I'm Google, if I'm Microsoft or whoever, I have unlimited funding, money is not an issue, who would I buy to promote my company and to get the best scale possible? And essentially, there will be a handful of companies. And the question has to be why? You do the root cause analysis to figure out exactly which is great fit. Let's say 2 or 3 companies emerge. And the interaction, the mindset has to be you are buying them and not the other way around. Even though eventually that could happen, but you are buying them. So you reach out, whether it's the VP of the business unit or the CEO, and you go to them with a very crisp value proposition that says, here's what we can do together. And those people are going to usually say, yeah, we get 50 LinkedIn messages, 50 emails a day. But once you establish that value proposition and you clearly articulate, here's what I'm going to do for you, by the way. Over the next 6 months, over the next 12 months, over the next 3 months, here's exactly what I'm going to do for you. And create an active pipeline of deals for them, where your product and their product, your service and their service, together the synergies far exceed the individual parts. Once they see pipeline being built, doesn't matter if there are 2 buyers potentially out there on the table, 5, 10, because that's waste. It's a lot of noise sometimes. If you have very clearly demonstrated that you can bring value to their bottom line, to their top line, and you can be in an enviable position of setting your price. Yes, fundamentally, logistically, you may say, okay, you know what, I gotta have a couple more people to sweeten the pot and create an element of competition. But with that important pre-step happening, oftentimes we see a strategic buyout happening at the right valuation, where everybody around the table is happy.
So I think your question was, are the public companies taking advantage of the downturn in the market as far as M&A? And the answer would be, well, if they feel like they can, of course they are. They stupid not to. And the question is, when can they take advantage of that? And it comes down to, the best M&A exits are when a company is bought, not when it's sold. And when it's bought, you get the really great M&A exits when you either have more than one buyer, as Peter said, or you have a company that says, we're really not all that interested in selling unless it's a really big number. You got a great business, you're growing, you're either profitable or you've got financial backers that are going to keep backing you because the sky's the limit, then you don't have to sell. And either of those are going to drive strategic type valuations that are not based on market comparables. When you're selling a company, you're doing a sales process because you have to sell. It's going to be based on market comps, and down market's going to affect what you get paid.
At what point should a company engage in an advisor, investment banker? How early on in the process?
Well, so our answer to that would be, we only think in terms of engaging an investment banker in an M&A process if we feel like we have to sell the company. Meaning, nobody's come to buy the company, and we've kind of given up on it ever being a really, really big success. And it's time to get liquid and to get out of the business. And so in those scenarios, we'll hire a banker to help sell the company, and that is a case of the company being sold. If the company is being bought, somebody comes to the company, puts an offer on the table, it's either, more than one that are out there sniffing around. A lot of times, most of the time for us, we don't engage there. We don't feel we need to do that. We feel that with the board members, the VCs involved, and quite honestly, some of the really good M&A legal counsel that's here in town that can actually help with that process a lot. There's a handful of really, really good M&A attorneys here. The combination of that, unless you're really going to go try and do a massive bake-off, it doesn't make sense. And you don't need more than 2 or 3 prospective buyers or the ability to say no to drive the price up. So you don't necessarily need to run a big process to do that. You can actually kill a deal by dragging it out, having it become too complicated and take too long.
My response would be only when you have to, which kind of mirrors what David is saying. When you have a term sheet on the table, or there's a capital crisis in the company, and as long as there's growth happening, you're growing nicely, in theory, and there's enough capital, working capital, you don't need to engage an investment banker. However, I would say that sometimes there is something very wrong with the way we think about investment bankers too. They can be a great source of partner creators. I talked about the importance of scaling the business and finding the right partners and channels. And people often think, when I'm thinking of an ID, I'm thinking of an exit. And it could very well be the case. Certain IDs are focused on an exit, or they represent the buy side or the sell side. But there are quite a few solid, good IDs out there that really help the CEO and the board assess partnership options. It can take a lot of bandwidth, a lot of time of the CEO to figure out what are the right partners. How do you narrow down on the top 2 or 3 where you can really move the needle? And you can outsource their function at a reasonable price, why wouldn't you? So sometimes early can be better.
Yeah, I think engaging is sort of like you want to do a transaction, but I agree with Venkat that in the early stages of the company, maybe not at the stage that a lot of the companies in here are at, but maybe after Series A or beyond. I think it's important to get in front of the right investment bankers to help put your company on the map with the potential pool of acquirers. They're out there all the time talking to those guys. And getting mentioned over and over as something interesting over time really accrues to your benefit. The other thing I've done with bankers early in the company's life cycle is brought them in just to talk about the model that we're building and learn from them how they think, what they think the various opportunities for value in the company will be down the road. Maybe this isn't so interesting for a standard SaaS-based model company, but for instance, in one of the companies that we're in Davidville, which actually grew out of the company that Venkat founded, we had some real theories about how we'd be able to get good valuations on the company in the future, and we tested it out on a couple of bankers, and we were trying to do something a little bit non-standard from a technology and services business, and that actually has proven out to be true. So there's that.
Open it up to questions, the audience.
With Colorado legislature, is there a place where you can learn more about this?
Thanks for the plan. I saw through the networking at the party, so Peter was mentioning the Colorado Venture Summit. June 8th, coloradoventuresummit.com, go to the party, sign up. Over 50 VCs already signed up for the main event, network with the evening party. It's basically free, so go to the website and register. Thank you for the plan. I have one follow-up comment I want to say, because I realized I didn't make clear the comment on M&A attorneys probably scratching their heads. The reason I bring up M&A attorneys is very similar to venture investments. There's a famous saying from a local VC that is, you name the price, I'll name the terms, and that's true in M&A as well. Price is one part of the equation. The terms can be extraordinarily complex, make a big difference over how much everybody ultimately makes, and so that's why M&A attorneys can actually be very, very helpful.
valuation going down, for 15 trades at the seeds today level, or the higher?
I'm not sure I understand the question. Retrade
We
is.
trade today, we have a downturn sheet, and we need to go back down.
We have not seen any retrades from you in our history. We've never retraded a deal.
Yeah, we don't take options lightly, so once that is on paper, we follow it so far.
So yeah, I would say that's true for us. And I'm trying to think of what if I've ever been retraded in my career, and I think the answer is I can't really remember ever being retraded. And that comes with having deals that I haven't taken out sort of broadly shopped to people I don't know. It'd be rare for us to do a transaction, to do a financing with a group that we've never seen or heard of before. I think that happens in Valley a lot. So we tend to do deals with the same people over and over again, so we really trading that here.
Colorado is a small town, so the word gets around.
Got a question on the robo-advisors coming into these financial sectors. So what's the impact of that on VC venture capital business? Have you seen any impact of robo-advisory platforms making some kind of decision impact on mergers and acquisitions or funding through that side of the story?
Can you repeat the question?
Robo-advisors, they're entering into the financial advisory sector right now for the portfolio management and several of the institutional investment side of the story. So I'm wondering if you have seen any of that impact in decision making for M&A or venture capital business.
No.
Robo-advisors, I think, are dealing mostly with publicly traded securities.
So when early stage companies come to you for early stage investments and they've gone through friends and family rounds, what do you like to see and not like to see from that?
Well, what we love to see is a really clean convertible. That's thankfully the way most of the deals get done here. What we don't want to see is 500 individual investors and $100 million pre-money value or post-money on the investment.
I would say ideally, those friends and family have been organized into an entity with one or two friends and family controlling the vehicle. So it's not a whole bunch of people to go chase down every time you're trying to do financing exam.
We just look out for crazy terms. So, yeah, and usually they're joined at the hip, right? Crazy terms and crazy people. But essentially, when people put unreasonable things out there, hopefully it's the CEO's job to explain and educate all of the friends and family because they may not have an inkling how it could really be an overall negative impact in terms of future fundraising efforts. So we make sure if those things don't exist, we make a point to meet the investors, introduce ourselves, because we come early on. We often see rounds where there are 15 people, 15 friends and family folks have invested, and we often take it upon ourselves to sometimes clean up the process so that funding tends to become cleaner. So going forward, it's a lot more structured.
What I really like to see in around the angel round of investment is an acknowledgement that we're entering a marathon, not a sprint. And that, in normal fundraising environments, each round of capital is called upon again and again and again to support the company. And I think in this last, I don't know if we're in a bubble or not, I'm sure it's probably to me, but I think the angel investment community, if it happens this time or again like it's happened every other cycle, there'll be a lot of rude awakenings about what it means to support a company until its end. And in normal times, most people don't get to put money in one round and then sit back and watch what happens. Budget to triple up or quadruple up or quintuple up on their initial investment in order to get to the end of the road. And I think as we go through a correction here, it looks like we are, there's going to be a lot of pay-to-play terms in subsequent financing. So just the general education of the group of friends and family or angels, I think, is really important on a go-forward basis.
Question, we do not have any investors per se, but we have employees and ex-employees, some hold stock, some hold options for stock. And just flat out stock. Is that a problem at all, or is that really?
It can be an issue, like Peter was saying, sometimes you have to chase people around to get signatures. So suddenly if you have 15 employees and things can go south sometimes with employees, believe it or not. And it tends to create a very uncomfortable situation, puts the company in an awkward spot. So it's probably an opportunity for a cleanup where employees still get the benefit of what they signed up for without the hurdles that a company has to go through every time it has to get their approvals. And that's why stock options are there for a reason.
I might have heard a different question side of the question, and I use this quote with a lot of my companies as we talked about how the capital structure changes over time, and let's say that in our business, contestants must be present to claim their prize. And so if what you're saying is we have 50% of our equity is in the hands of people that are no longer with the company, so we're a young company, that's a problem. Because there's only 100 points of equity to motivate everyone. So it's not, what you said is not necessarily a problem, but it's a question, right? And that this problem, if that problem exists, and the Venkat stuff, which is when you go through and financing, which is time to probably trying to clean that up so that the organization has the best shot of succeeding over time.
I'll give you a quick tip. There is something called non-voting stock. So as part of the cleanup, you can do a one-to-one between a regular founding versus a non-voting stock. You spend 5 days with attorneys, but it's usually worth it.
But this is on the order of just 10% of the company.
Doesn't matter because minority shareholders have a lot of rights to it.
Another question from that?
Are there any upcoming industries, trends, products that you guys are particularly interested in? Artificial intelligence, automated cars. What's kind of the next thing coming up in 5 years that you guys are interested in?
Well, I told you that. Tell you all our secrets, right? Just kidding. Yeah, so you mentioned one of them, artificial intelligence, natural language processing. We've been investors in that. We sold the company to IBM here off the API, very successful exit, M&A, two bidders. So it was a very good exit. So classic case of a company being bought. For us, it was bittersweet. For the founder, it was fantastic, and we understand why you wanted to sell. For us, it was like, wow, we thought this could be $1 billion company, but it was hard to say no given the ridiculous price that they paid for the company. So that is a very interesting area. Big data analytics. We made an investment last year in a company called Slam Data. If you're familiar with Tableau, it's doing Tableau for NoSQL databases, doing analytics on NoSQL is very challenging. There aren't good tools and technology out there for doing that. They have a very cool way of being able to drive analytics on NoSQL databases. So anything around big data is also very interesting. We continue to be big believers in IT security. We're investors in Logarithm. We have a term sheet out right now for IT security company. We expect to continue to back a lot of companies in the security space as well. So I would say that's sort of top of mind. Those are some of the areas that are most interesting to us.
We tend to look at, of course, everything David said makes a lot of sense. You read about them a lot, you hear about robotics, mobile, IoT, and so on. But we take a very slightly different approach. We take a very focused approach on the vertical, the industry vertical. What's the disruption that's happening there? One example is digital media. people have made a lot of money in digital media. We have seen great exits recently. We have seen Gartner gobble up a bunch of those companies. And these have been bootstrap companies which have been throwing off cash for a long time for their investors and their principals. And applying technology in those areas allow them to get nonlinear scale. And that nonlinear scale is something that's of interest to us. So digital media, media in general, especially digital media, technology-enabled digital media is one. Another area, another vertical is education and social in terms of doing good out there, not the social media. Those are extremely interesting things that are happening, given there's a lot of wounded events, wounded parts of the world that need help. And there are a lot of the companies that are coming on. Today we heard about FoodX, right? I mean, again, I could see my mind was going into all the social aspects of something like this in third world countries and the power of that kind of logistics that is enabled in the right way to do magic. So we look for those kind of disruptions in specific verticals.
As I said earlier, we're not thematic investors, so I never really have an answer to that question. And when something is hot, I figure it's too late for us to invest there. So, we kind of call them as we see them, as they're brought to us. We're looking for places, as Venkat says, where the application of technology gives a small company some kind of leg up, product cost, product market fit, the ability to execute a business model more efficiently than the competition. And the thing that I hate most is waking up one morning and finding out one of the deals has 20 competitors. I just think that that's the kiss of death for the whole thing.
So I have a startup software company, and my question is, how raw of a company are you willing to take? It sounds like you're saying if they're far advanced, they're too much for you. But at the same time, they may be kind of green in terms of their ability to execute. Maybe they have to create incubators or something like that. How do you deal with that, or how do you bridge that gap? Or do you bridge the gap?
I'm not sure about the whole question, but you're saying how early will we invest? We have done, Raleigh was, one guy from Brad Feld's shop and one guy from our shop, and we sent them out and started a business, right? That's not typical, and those are nice when you find them. So we'll do things very early in the day, we'll do things very early, and that's very early. A deal has a catalyst, and that's what you're looking for. The catalyst changes throughout the life of a company. The catalyst for a really early stage company could be a really compelling product opportunity that looks like there's something to be done there. It could be a really compelling product that sort of sets itself apart from everything that's out there. That I alluded to earlier, line rate was such a thing. A couple of professors from the university said, well, if this works, it's going to be really valuable. That was the genesis of that deal. Even though I didn't think we had people who could build a business, that was what was a catalyst. Or it might be a really compelling leader or CEO who just wanted their money from it. So, those are the things we focus on rather than how early or late is it.
Yeah, so we apply the VC test. Sorry guys, we just call it the VC test because pitch as though you're pitching to a Series A investor, a proper institutional investor. And we look at the level of preparation the entrepreneur has gone through during the pitch. It could be a product that's pre-MVP, it could be a product that's still in a PowerPoint, it could be a Visio diagram, but if the preparation is there, the entrepreneur has brought us a game, so to speak. That's interesting for us. And we help them get in terms of making it more tangible, putting them in touch with the right development shop that can create a prototype quickly, even fund those prototypes if the opportunity is a good fit. So it depends.
So most of our first investments are in SaaS companies, are going to be companies that have $50,000 to $100,000 a month in recurring revenue. That's the middle of our bell curve. We definitely, I mentioned Slam Data, they're pre-revenue, and software, but they have no revenues. We're just now getting the first revenues. So we will go earlier, but when we go earlier, like most venture funds, honestly, it's usually because we had some pre-existing relationship with one or more of the founders who predates the start of that company. And raising early stage money is a social sport. It's about relationships, and the earlier you are, the more it's about relationships. And so when you look when we went early, and there might be an exception. There's very few. There usually was at least one founder. We've known the founders of Slam Data for 7 years. So they didn't start the company 7 years ago. They were a different company. We've known them for 7 years.
How important is a successful experience with an accelerator? Is that something you would highly recommend to the startups out there, or is it depends? Tell us about your thoughts on accelerators.
So it depends, and it depends on the entrepreneurs. You know, Peter and I talked about this with angel networks. The truth of the matter is, just speaking factually, that when it comes to accelerators, when it comes to angel networks, there's adverse selection. The best entrepreneurs don't need to go through either of those. They've probably done it before, they've probably raised money before, they have the personal relationships, they've known us for 7, 10, 15 years, maybe they were an handler at Inspirato. We partner packed a company before last, known him for 12 years. You didn't do all that. You raised a $14 million Series A round for us and Kleiner Perkins. Why? Because of his relationships, because of what he's done. So there's adverse selection of those. So if the entrepreneur has never built a company before, has no solid understanding how to do that, doesn't have the relationships they need to raise the money, and needs more relationships on the business side, that's what the accelerators add value. For those types of entrepreneurs, they can add a lot of value, but they're not cheap. They take a big chunk of equity for what they deliver.
We like to see that. A lot of it is because we don't believe in the closed door, and network. It's very hard to get into the network. And somebody, a VC, once made a comment, maybe a VC, that if the guy is not reaching out to me, the entrepreneur, to someone I know, the guy's too lazy, I don't want to invest in him. So we take a more compassionate approach, and we believe that these accelerators add a lot of value. And we are very proud that locally we have a couple of good ones. So we do look for them, and they are often a good thing. But being a smaller fund, being a newer fund, we are not often fortunate enough to attract those graduates as well. They're usually well plugged in, and they go on their very way for meeting high.
I think the accelerators add value in general to the entrepreneurial ecosystem, and they educate a lot of people about what it means to be an entrepreneur and how hard it is to run a company. And when they do actually get into the nuts and bolts of helping entrepreneurial teams sort through strategic alternatives or market positioning and customer selection, I think there's value there. My pet peeve with accelerators is that everybody that comes out of the accelerator world gives pretty much the exact same pitch, the exact same body language, the exact same intonations, and I just kind of long for my youth as a venture capitalist when a completely geeky tech founder got up there and mumbled through the presentation, but really was just locked on to what the value of what he or she was doing was. So, and I think it'll be interesting to see, because historically, accelerators or incubators or whatever you want to call it, they have not ever survived through a downturn in their business. And that's because, and this time really interesting because they are so dependent on the pool of angel money that's out there to keep those things going. I mean, once angel money dries up, then there's nobody to fund those things, there's nobody to pay the accelerator's bills, or for the real estate player, there's nobody to run cubicles. Historically, they've evaporated pretty quickly. we'll see what happens this time around.
Time? Okay, all right, sorry guys. It looks like we're having drinks afterwards, so make sure you grab these guys. So thank you very much to our panelists.
All right, thank you panelists, thank you Ron, David, Peter, Venkat. So just real quickly before we break off and go get some networking time in, I want to thank everybody for coming, but I also want to let you know who our winner for tonight is. Yeah, see now you're all intrigued. All right, so we were tabulating your votes from earlier tonight, so thank you for doing that. And to thank our panelists and our victors for tonight, we have a lovely selection from Rocky's Venture Club Vineyards. Pretty nice. Pairs very well with the venture capital fundraising process. Consult the paying due diligence very nicely. All right, so your top company for tonight, in terms of quality of pitch presentation and quality of the deal, is FoodX. Thank you all for coming. Thank you to Richard and Boulder Denver Software Club. Stick around and network, and we'll see you June 14th at Boulder for our next event. Thanks.